Rewind 20 years. A god appears and offers you a deal no human has ever had. Perfect foresight. You get to build one portfolio today, 2 decades in the past, out of the 10 largest companies in the world right now, the giants everyone knows. Equal parts in each. Only future champions. 0 mistakes. 0 bad picks. The single most powerful portfolio that could possibly exist. You say yes, obviously. And the wealth it produces is astronomical, a number that does not look real. But watch the road it travels to get there. Because even this divine portfolio, built from nothing but winners, would have dragged you through years of pure terror, watching your fortune collapse again and again on the way up. Look closely, and this perfect portfolio teaches you 2 things almost nobody understands. The first is brutal. The very companies that return the most are the ones that fell the hardest. Amazon once lost 94% of its value and took the better part of a decade just to get back to even. Nvidia crashed 90%, then 85%, then 66% in 3 separate disasters. Apple collapsed by more than 80%, twice. These are the winners. Return is not handed to you for free. It is rented, and the rent is paid in falls you have to survive. The second lesson is even more important. You could never have built this portfolio in real life because choosing the 10 biggest companies of today requires a time machine. 20 years ago, you did not know who the winners would be, and several of today's giants did not even exist on the market yet. They had not gone public. The divine portfolio was literally impossible to buy. That trap has a name: survivorship bias or hindsight bias. And I am showing it to you first, on purpose, so that for the rest of this video you are immune to every beautiful backtest that quietly assumes you knew the future. So here is the law the entire video turns on. You cannot choose your return. Nobody hands you a number and says, this is what you will earn. What you actually choose is something else. How much pain you are able to survive. How deep a fall you can sit through without selling, and how long a wait you can endure before it comes back. You pick the drawdown you can live with, and the return follows from that choice. Return is rented, and the rent is drawdown. So from here on, we judge every portfolio on 2 axes, and only 2. The first, how fast it grows over the long run. The second, how far it falls from its peak, and how long it takes to climb back. On the growth axis, higher is better. On the drawdown axis, less is better. The shallower the fall and the shorter the wait back, the better. Every strategy in the world, however sophisticated it looks, is just one point on that plane. A specific combination of how much it climbs and how much it makes you suffer along the way. Nobody escapes those 2 axes. And grasping that, before you look at a single portfolio, changes everything. Now let us plot 5 of the most popular passive portfolios onto it. And I want to be clear about what this is not. It is not a ranking, and at the end I am not going to crown a winner, because there isn't one. We are here for the data, nothing else. Each strategy gets the exact same picture. On top, the wealth curve, how the money grew. And underneath it, the part most people never look at, the underwater chart, which shows at every single moment how far below its last peak the portfolio was sitting. The top tells you the reward, the bottom tells you the rent, and you'll see that 2 portfolios can end at a similar amount of wealth having traveled completely different roads, one climbing in a near straight line, the other falling into a deep pit and clawing its way back out. That pit is what really decides whether you stay invested or sell at the worst possible moment. We start with the aggressive anchor, 100% stocks. The whole world stock market in a single fund, owned outright, with nothing held back in bonds. Over a strong decade, this compounds near the very top of the pack. Nothing beats owning the whole market when the market is rising. That is the reward, and it is real. Now look underneath. In the crash of 2008, this portfolio fell by roughly half, and it took a few years to climb all the way back to where it started. Highest reward in the room, and the deepest hole in the room. That is not a flaw in the strategy. That is the rent. Next, the textbook balance. 60% stocks, 40% bonds. For half a century, this was the default grown-up portfolio. The idea is simple. When stocks fall, bonds are supposed to hold steady and cushion the blow. And for decades, that is exactly what they did. Then came 2022, and the script broke. Stocks and bonds fell at the same time, together, and the portfolio lost about 1/6 of its value in a single year. its worst year since 1937. Two things falling in lockstep like that had happened only a handful of times in 50 years, and it did not fully recover for a long while after. The lesson is not that diversification failed. The lesson is honest and narrow. Diversification softens most storms. It does not promise to soften everyone. Third, the golden butterfly. This one spreads the money across stocks, long-term bonds, short-term bonds, and gold. Its whole philosophy is the opposite of winning the race. It is about barely feeling the road. And here is its real edge. Over this stretch, it nearly matched the classic 60/40s growth, almost the same destination, while falling far less along the way, roughly 2/3 of the 60/40's worst drop. Look at its underwater chart against the 60/40. The troughs are shallower, the recovery's quicker, the same kind of return on a noticeably calmer road. That trade is why so many people are drawn to it. Fourth, the permanent portfolio, designed by Browne. His idea was almost philosophical. Split your money into 4 equal parts: stocks, long-term bonds, gold, and cash. 1 part for each kind of economic weather: prosperity, recession, inflation, and deflation. Whatever the economy throws at you, something in the mix is built to hold. Its volatility runs at less than half the stock market's. In the worst crashes, its fall was a fraction of what the all-stock investor lived through, and across 50 years it never suffered a single catastrophic collapse. The price of all that calm is a lower long-run return. This is the conservative anchor of the whole menu. And fifth, the one with the famous name behind it, All Weather, from Dalio, built on an idea he calls the holy grail of investing. The principle is sound. Combine enough genuinely uncorrelated streams and you cut risk faster than you cut return. It is not magic. It is just diversification taken completely seriously. The mix leans on stocks, long and intermediate term bonds, gold and commodities. But here is the honest part, and we are not going to hide it. That heavy lean on long-term bonds is exactly what hurt it in 2022, when bonds fell hard alongside stocks. And over this stretch it grew the least of the 5. Every design, no matter how clever, has a season it dislikes and a price of its own. There is no exception, not even for the most famous one. So which of these 5 is the best? None of them. The question itself is the trap. There is no best portfolio because best depends entirely on a fall you have not lived through yet. The highest number on a chart is worthless if you sell at the bottom of the next crash and never see the recovery. The best portfolio is not the one that wins the back test. It is the one you can actually hold for 20 years without selling in the worst week of your life. The one you abandon is always worse than the modest one you keep. And if all of this feels like a lot to weigh, know that it is increasingly handled for you. Robo-advisors and target date funds rate how much of a fall you can tolerate and assemble the mix automatically. Think of it as your risk profile delivered as a service. To recap, you do not pick your return. You pick the drawdown you are able to survive, and the return follows from there. Every portfolio we walked through is just a different answer to one single question: how much falling can you live through? The aggressive anchor offers the most and demands the deepest hole. The conservative ones ask for far less pain and hand back a calmer, smaller return. There is no winner. There is only the one you will actually hold. This is educational content, not financial advice or an investment recommendation. We analyze, you decide. If this cleared things up for you, subscribe to the My Best Wealth channel.